Hello there, folks. Doc White here, coming to you from Virginia Tech, here to talk to you today about retirement planning for business owners. And I'm being brought to you today by the Water Systems Council, so I appreciate their thoughts for bringing this into your overall series. Again, my name's Alex White. I teach here at Virginia Tech, and I teach personal finance, I teach business finance, and I teach agricultural finance. And I work with a lot of producers in all different areas. So, big question you're going to be asking right now is, why do we talk about retirement planning? So it provides significant tax advantages. And if you think about this, most business owners want to minimize their taxes. So they're going to go out and spend something for Section 179 expenses that may not be in their best interest. In my opinion, retirement planning gives you much better tax advantages than those Section 179 purchases. While we're talking about taxes, I am not licensed to provide specific legal, tax, or financial advice for a fee. I just speak about this stuff from an educational standpoint. So we talk about this retirement planning because it gives you significant tax benefits. Also, do you want to rely on Social Security when you retire? Is it going to be there? Is it going to provide enough to meet your needs? Another reason that this is a good concept for business owners, it helps with business transition. When you want to get out of business and bring the next generation in or the next management and ownership party in, it's so much easier, so much less pressure if you have some retirement funds set aside. Another nice thing about retirement plans is it's judgment proof. That means that the money inside your qualified retirement plans cannot be touched in a lawsuit. If someone sues you for negligence or whatever purposes, they cannot touch this money. Maybe Jesse Richardson can, I don't know. But for the most case, it is not. It cannot be touched in lawsuits. So this protects your money from outside sources. And another reason we talk about retirement planning is to enable you to retire when you want to retire and to do what you want to do during your retirement. It tears at my heart when someone makes the statement, oh, I've got to work another 5 years before I can retire. If we do the retirement planning properly, you don't have to wait that extra 5 years. You can do it when you want to. So that's why we're going to talk about retirement planning here today. For the next slide, the topics we're going to speak about are determining your retirement goals. What is it exactly you want to do in retirement? We're going to talk about how much you're going to need in your retirement accounts to meet your goals. I'll talk about 3 or 4 programs or plans where you can keep your money or invest it for retirement. We'll talk about the income tax implications. And again, please seek out qualified tax advice. Don't just rely on my educational version here. And we'll end up talking about allocating your investments inside those retirement plans. And I'll talk a little bit about estate planning as well, because a lot of people confuse estate planning and retirement planning. So the next slide says you want to retire, huh? Again, will Social Security be there for you? Realize it's only there to provide about 40% of your pre-retirement income. If you're like most business managers, you've been minimizing your adjusted gross income to minimize your taxes. Well, you're also minimizing your Social Security benefits as well. And that's not just retirement benefits. That's going to be survivor benefits as well. How about this? Are you planning on selling your business assets? When we get out of business, a lot of times you'll sell your assets to the next management and ownership parties. Well, how do you put a value on it? Chances are you're going to overvalue that. It's not going to be worth as much as you think because of sentimental reasons. Also, because of the tax moves you've made throughout your business experiences there's probably going to be significant tax implications that's going to take a big bite out of the sale proceeds. And again, if we're going to transfer the business to the child, that's a whole new can of worms. We need to talk more about retirement planning. We need to talk about transition management before we start making too many steps here. So for retirement planning, why is it good? It reduces your reliance on Social Security. It reduces the need to sell your business assets all at once. It gives you the option of selling it a piece at a time or leasing it and helping that next generation or next ownership party move into the operation. It takes off a lot of cash flow pressures. And then from a tax standpoint, The retirement plans I'm going to talk about today are going to give you tax deductions, which reduces the amount of taxable income. It's going to give you tax deferral, which says let's push the taxes off until the future. And we'll talk about tax-free earnings when you hear the term Roth or post-tax investments. Excuse me. So the next slide is going to get you thinking about retirement planning. What I want you to do is start now. The earlier you start planning for your retirement, the more options you have, the less money you have to invest, the less risk you have to take. So let's start thinking about it now and start setting money aside. My example here is think about Walmart greeters. If you've been to a Walmart or some big box store, they usually have a greeter when you walk through the door. And when I ask my students, I say, what kind of people are the greeters? And they always say old people. Well, yeah, I guess they're pretty much right. But if you think about it, there's two types of Walmart greeters. There's the real happy ones. Hi, thanks for coming in today. How are you today? Would you like to have a cart? And then there's the grumpy ones. Would you like a cart? And they, hit you in the shins with the cart and grunt at you. Well, the ones who are happy, they're working there because they want to. They have enough retirement income to meet their needs. Yes, they're getting some income. They're getting some, maybe some health insurance benefits and so on, but they're out being active. They're out doing something they like. That greeter that's just sort of grunting at you and then throwing a cart your way, they're working because Social Security is not paying their food bill or their rent or their electric bills. So they have to work during retirement. And folks, having to work during retirement changes your attitude pretty significantly. So I want everybody to retire and be the happy Walmart greeters out there. So for retirement planning, the first steps we need to think about is when do you want to retire? Chances are it's not going to be too much before age 55. It's probably going to be up there closer to your mid 60s. But think about it from your situation. When would you like to retire? Also, what do you want to do when you retire? How much do you want to travel? How much do you want to spoil the grandkids? How much do you want to go to your second home, or do you have a second home? But think about what you want to do. What's your expected lifestyle during retirement? And then we can start thinking, what is that lifestyle going to cost per year? Once we have that figured out, we need to look at what are your sources of income during retirement. And the main sources there are continued work, which means you're not retiring, Social Security, which means you're not going to get a very big check, or we can live off our business or our personal investments, or we can live off the lease income from leasing your assets to someone else. So those are sort of the main sources you're going to have during retirement. You need to think how that's going to impact your specific retirement needs. And then we need to think, what do you want, or how much do you need to invest to reach your retirement dreams? This is where we need to think about, how much it's going to cost us, how much risk do we want to take in our investments, how much do we want to reduce the taxes for our business. This will help us figure out how much we need to set aside and how we invest those funds. So on the next slide, it says, how do I do all this higher level math? Well, there's lots of different calculators out there that you can use. Online, there's the one at bankrate.com has a nice retirement calculator. Money at cnn.com has a good retirement calculator. And I have a handy dandy retirement planning spreadsheet that if you switch to the next page, it'll show you sort of the main portions here, where with the top lines say, okay, how many years until you retire? And then how many years do you plan to be retired? So the first step says how long until we get that retirement age. The second line is how long do we plan to be retired? Then it asks, what's the nominal inflation rate you expect over that time frame? To be honest, I usually use 3 to 4%. And then what's the nominal rate of return on your investments? Then we can work down through the rest of the items here that are in blue, figure out what lifestyle you'd like to have, how much money you currently have set aside for retirement. And this spreadsheet will help figure out how much more you need to invest per year to reach your retirement goals. Speaking of which, if we move to the next slide, this will give you some goals. People always ask, well, how much money am I going to need when I retire? Well, if you're 25 or 35 or younger, hold on to your seats. This might make you feel a little queasy. You might fall off your chair. But a 25-year-old, you're going to need somewhere around $3 to $4 million per household when you retire. So that's how much money you'd need in your retirement accounts. If you're 35, we're going to need that 2 to 3 million. If you're around 55 years old, 500,000 to a million, maybe a little bit more than that, will set you up for a relatively safe, successful retirement. For this, I'm assuming that you're living off the equivalent of $50,000 per year in today's lifestyle. And this is going to last us for 30 years. It's adjusted for inflation. And we have that 3% annual inflation in there. A quick little rule of thumb for you, if you look up in the top right-hand corner, if you take the number 100 and divide it by your age, that'll give you a rough estimate of how many millions of dollars you're going to need in your retirement account the day you retire to adequately fund your retirement years there. Okay, so people look at that and say $3 to $4 million. That's an awful lot. If we start investing early, it's easier to reach that goal. So when you do retire, you're going to need what I call liquid equity. This is cash you can put your hands on. This is equity that you have that is easily converted to cash. If you think about it, for an awful lot of Americans, an awful lot of business owners, this is going to be their business assets. This is going to be their house. This is going to be land, other hard assets that they have. Well, when you sell that, there's going to be some pretty significant tax implications. Another option for you is to use some of these retirement plans or have a brokerage account with a financial advisor. Financial investments and retirement plans, they're liquid already. We can easily convert them to cash. And depending on the type of plan we have, may not be as much tax implications. Down there at the bottom of this slide, it says, if you sell your business assets, okay, if you've got a big company truck and all the other heavy equipment you might need for running your operation, when you sell that, studies have shown that 30 to 60% of the proceeds might be eaten up by deferred taxes or by sales commissions that you're going to have to pay. So if you had $1 million worth of business assets, that could very quickly become $400,000 to $700,000. That can have a significant impact on your retirement lifestyle. So we need to think about how your business assets are going to be taxed when you sell them. So here's an example of how retirement planning can help you. Let's look at putting $6,000 per year into a traditional IRA. That's an individual retirement account. And let's assume that you're in the 25% marginal tax bracket. Well, by putting $6,000 into this traditional IRA, because it is tax deductible, as long as you're underneath the income limits, the adjusted gross income limits, if we multiply that 6,000 times 25%, by putting $6,000 into the IRA, you saved yourself $1,500 in income taxes. Now, folks, take a step back. You paid $6,000 into your IRA. You're writing a check to yourself and you're saving $1,500 in income taxes, as opposed to writing a check to the machinery dealer or the supply dealer where they're getting the money and you're now saving yourself $1,500. As long as the money is inside the account, whatever it earns, there are zero income taxes. These income taxes are deferred until they're withdrawn from the account. So as long as the money stays in there, you're not paying taxes. That money gets to grow and grow a heck of a lot faster. Now then, when you pull the money out of a traditional account, all the withdrawals you take are going to be taxed as ordinary income at the time of withdrawal. There will not be any FICA or FUTA taken out. It's just going to be ordinary income taxes. So in this case, if we look at the numbers, your $6,000 per year is going to grow to over $1 million over this 35-year period. And I'm assuming an 8% annual return, which is not unheard of. This is going to be less risky than stocks, more risky than bonds. So if we look at a balanced portfolio, we might be somewhere in that 8% range. The next slide shows a graph of how this grows. Over the first 5 to 10 years, you don't see a whole lot of growth. But then as that return starts to compound, as those earnings really start to grow, this thing starts to grow exponentially. So after about 20 years, 30 years, you really start to see this take off. That's why I want you to start investing in for your retirement as soon as you possibly can. Now then, the next slide hits what every business owner hates paying, and that's taxes. Well, folks, if you're paying taxes, that means you're making money. That's not a bad thing. But in this case, let's look at the tax implications. Here, you invested $6,000, but you got $1,500 of tax savings for doing that. So basically, you invested $6,000 for the price of $4,500. That's a pretty good deal. As long as the money's in the account, there are no taxes. So it's growing tax-free or tax-deferred while it's in the account. So over this 35-year period, you put $6,000 in every year. You've invested a grand total of $210,000 of principal. That's grown to over $1 million. It goes to $1.2 million. And so far, before you start taking any money out, there are no taxes that you've paid. Folks, if we paid that $6,000 a year for Section 179, and that's going to save us, so we invested $210,000. If we're in the 25% tax bracket, that gave you roughly $52,000 worth of tax benefits, and that's a once and done benefit. In this case, you invested $210,000, and it grew to $1.2 million. So this is why I like retirement plans better than Section 179 purchases. So with the next slide, let's talk about retirement planning. If we've done this over time, when it comes time to retire, you don't have to pull money out of the business. So if this is a family business where the next generation is continuing to operate it, you don't have to pull money out of the business to meet your living needs. That reduces the cash flow pressure on that next generation. Also, you don't need to sell the assets. You've bought yourself time. You've bought yourself options by doing this retirement planning. All right, let's get down to the rat killing here. The next slide shows you some of the main retirement plans that are in effect for small businesses. And the two I want to talk about are the Simple IRA and the SEP-IRA. A simple IRA is very much like a 401k plan, but it's specifically for small businesses. And a SEP is like a corporate pension plan. And again, it's for small businesses. The SEP tends to be better for family businesses where most of the employees are family members. The simple IRA tends to work when you have lots of employees and most of them are not family related or family members. There are some other plans out there, but these are the two main ones you're going to see for small businesses. From a personal standpoint, as long as you are a U.S. citizen and you have earned income, as long as you meet the adjusted gross income limits, you qualify to put money into either a traditional IRA or a Roth IRA. So let's hit these things and tell you a little bit more about them. With a SEP-IRA, this is a pension for small businesses. With this one, you can invest up to 25% of each employee's earnings into an IRA for that employee. So again, if your employees are family members, you're giving them retirement funds, and every dollar that you contribute to this fund is tax deductible to the business. So it's going to reduce your business taxes. So we can go up to 25% of each employee's earnings to a maximum of $57,000 per person. For the business owner, it's 25% maximum, but after we take into account some of the tax implications, it's closer to 20% of the business profits that you can invest for the owner. So in going into the owner's IRA, again, up to a maximum of $57,000 per year. You need to use the same percentage. You don't have to do the maximum. If you only want to do 5% of their earnings or 10%, you can do that. But you need to use roughly the same percentage for all of your eligible employees. Think about this. If you put $57,000 into a SEP IRA and you're in the 20% tax bracket, you just saved yourselves, $11,000 worth of taxes by paying yourself rather than paying someone else. So a SEP IRA is great to put a lot of money away, and this tends to be better for businesses where most of the employees are family members. The next retirement plan is called a Simple IRA. Simple is like a 401k for small businesses. If you have less than 75 to 100 employees, you don't want to have a 401k plan itself. It's going to be too administratively expensive. But a simple IRA is cheap. So if you have less than, say, 75 employees, what you're going to do is set up an IRA for each eligible employee, And then you're going to make a contribution as the business that's equal to 1 to maybe 3% of the salary for each of those eligible employees. This contribution, again, is tax deductible for the business. The employee then can say, hey, I want to invest in this as well. They can invest up to $13,500 per year out of payroll. So the business will make these contributions on behalf of the employee, but this is being funded from the employee's paycheck, not from the business itself. So we can put up to $13,500 per year into the simple IRA. And if you're over age 50 as an employee, you can put an additional $3,000 into this account per year. As the business owner, you are still considered an employee. So you'll set one of these up for yourself and all of the eligible employees. And the IRS has guidelines for who's eligible. So if we recap this one real quick on the next slide, it's going to tell you that we're going to set up for both of these plans. We're going to set up individual retirement accounts for all of our eligible employees, including yourself. And we're going to make contributions by the year end. This, you probably want to work with an accountant or an investment person to make sure we're doing this properly. We're meeting all the requirements, but we're going to set up the IRAs. All of the contributions that the business makes are tax deductible for the business. So that's going to reduce business taxes. All of the earnings are tax-free. Actually, tax deferred is a better term for that. But you're not paying any taxes on the earnings of these accounts as long as the money stays in the account. And then with all of these, when you withdraw some money, as soon as you withdraw it or during the year you withdraw it, you'll be paying ordinary income taxes, but there's no FICA or FUTA deductions on this. So this is a way to push your taxes into the future, get tax deductions today, and let that money grow from a tax deferred standpoint. Folks, I think this is much better than spending money on Section 179 at the end of the year. All right, so the personal plans we have out here, those, the SIMPLE and the SEP, are business retirement plans. From a personal standpoint, we've got traditional IRAs and Roth IRAs. With a traditional IRA, as long as you are under a certain adjusted gross income limit for your household, you can contribute up to $6,000 per year or 100% of your earnings, whichever is lower. So up to a maximum of $6,000 per year. This is going to give you a tax deduction. So this will reduce your taxable income. There will be no taxes on the earnings throughout the year. And when you pull it out, it's just going to be taxed as ordinary income. So this is going to be taxed the same way as the SIMPLE or the SEP-IRAs. This is a really good plan if you expect to be in a lower tax bracket when you retire, because what this does, it gives you a tax benefit today, and then it pushes off the remainder of the taxes until you're in a lower tax bracket. So we can lower the total amount of taxes we pay over time. So a traditional IRA is one option for you. The next option is called a Roth IRA. And with a Roth IRA, all the all the contribution limits are the same. It's up to 100% of your earnings, up to $6,000 per year. There is a $1,000 catch up on both of these if you're over age 50. And there are income eligibility limits. I don't memorize those things. We can look them up in the IRS. With these accounts, all of your contributions are after tax. So that means it has zero impact on your taxes this year. However, with a Roth IRA, as long as you've had that account for at least 5 years by the time you retire, when you start taking money out of the account, all of the withdrawals will be tax-free. Younger folks, this is an incredible opportunity for you. It can give you 20, 30, 40 years of tax-free growth. Roth IRA is wonderful for people who expect to be in a higher tax bracket during their retirement years. So this gives you, you're getting the tax, there's no tax benefit now. You're paying the taxes now while you're in a low tax bracket. And then when you're in the higher tax bracket, everything you pull out is tax-free. So we can make a contribution to both the Roth and a traditional IRA in the same year, but the maximum combined contribution has to be less than the $6,000 per year, or $7,000 if you're age 50 or older. The next slide is going to show you the maximum contributions. So for your traditional and Roth IRA, it's $6,000 per year. with $1,000 catch up for those who are over age 50. For your simple, the employee can put $13,500 in. Again, there's a catch up provision for those who are over age 50. For the SEP, for the owner, it's going to be about 20% of the business income, after tax income. For the employees, we can put roughly 25% of their earnings, up to a maximum of $57,000 per person per year. So folks, this is a nice way to set money aside for retirement, to reduce your income taxes, and it's going to be protected from lawsuits if something bad were to happen. All right, one big question I always get is, how do I invest this money? What the heck do I do? I don't know anything about investments. Folks, it's probably worth your time to talk to a financial planner to figure out which retirement plan is best for you, or which combination of plans is best for you, and to help you figure out how to invest the money. But the money that goes into these retirement accounts is going in as cash. So you're making your contributions in cash. And then once it's in the account, it will be invested in a combination of stocks, bonds, mutual funds, certificates of deposit, and so on. Here's a rough rule of thumb on how to allocate your money inside your accounts. Your age is going to be the percentage of your portfolio, your entire retirement portfolio, that you want to have in these safer investments, which we call fixed income investments. This will be bonds, bond mutual funds, certificates of deposit, and there's a few others in there, but those are the main ones. 100 minus your age would be the percentage of your retirement portfolio that you want to have in the riskier investments, or what they call equities. This is where you're owning stocks or stock mutual funds or real estate, rental properties, those types of things. So this gets you in the ballpark. This is a starting point for your allocation, and then we'll adjust these based on your risk tolerance. If you don't like taking risk, if you don't like seeing your portfolio decreasing rapidly, from month to month, then we'll put more into the safer fixed income investments. If you don't mind, if you have 20, 30 years until you retire and you don't mind if it bounces around, but you'll earn a heck of a lot more over time, let's increase the percentage that we're putting into the riskier investments or the equity investments. So we can tailor this based on your risk tolerance. We can base it on other investments that you might have. Say you have a military retirement plan, or a federal retirement plan, or a pension from somewhere else. Well, that's a set form of income that you have. That's relatively safe. That means you can take more risk on your personal retirement investments in the hopes of earning a higher rate of return. So we need to think about that one. And then we're going to adjust this thing as you get older. So as you get closer to your retirement age, you want to take a little bit less risk. When we retire, we want to make sure that money is going to be there and it's going to be relatively safe, but we don't want to put it all in a savings account or CDs. We need to still keep earning at least the rate of inflation. I'd say double the rate of inflation during your retirement years. So how do we allocate this stuff? The easy way is let the professionals do it for you. When you put the money into the IRA, then you can invest it into what's called an asset allocation, or a retirement target fund. And you can tell these because they're going to have a year in their title. They're going to say 2040 or 2050 asset allocation fund. That year is going to be close to the year that you plan to retire. So if you plan to retire in the year 2050, you might think about using a 2050 asset allocation mutual fund. What this is going to do, the professional money managers are going to manage your money inside the mutual fund, and they're going to invest it relatively risky right now. But as the year 2050 gets closer, they're going to take less and less risk. They're basically using something like that 100 minus your age rule. They're going to be more scientific about it, but it's going to be close. So as an example here, if you are a 30-year-old today and you're looking at retiring at age 65, that gives you a 35 years until retirement. So if today's 2020, my God, let's get 2020 out of here. I'm done with this year. But let's add 35 years to 2020. That gives us 2055. So if you want to use the asset allocation fund, you could use the 2055 fund, and your money will be managed assuming that you're going to retire around the year 2055. If you don't want to take that much risk, if you don't like financial risk, use a year that's closer to today. So maybe the 2040, 2045, 2050 fund. If you want to take more risk, then go beyond that date. Use the 2060, 2065 asset allocation funds. That will suggest you to more, or excuse me, expose you to more risk over time, which should give you higher returns. But again, your asset values are going to be more variable or more volatile. All right, let's blow your heads up here real quick. If you want to do the asset allocation yourself, well, what we can do is use that 100 minus your age rule and say, okay, for a 30-year-old investor, let's put 30% into the fixed income. So this would be bond mutual funds or CDs or U.S. government bonds or whatever combination you have there. And then the remaining 70%, let's use stock mutual funds, real estate, and so on. And we can break this up to diversify your funds to get them spread around the entire world. By doing that, that will smooth out the risk that you're taking. It'll smooth out your returns. Yes, it's going to hurt your returns a little bit, but you're taking less risk so you can sleep better at night. So an option here is let's put 10% of our money in international funds. Let's invest outside the United States. And a rough rule of thumb I like to use is I don't want to get too much above 10 or 15% of my investments outside the United States, simply from a risk standpoint. We can invest 5 to 10% in real estate. This could be rental properties or other houses that you're looking to flip or so on. We could put some of this into large U.S. funds. These are called large cap funds. So maybe 30% is going into the Russell 1000 or the S&P 500 mutual funds, index mutual funds. Maybe we want to invest in the small cap funds. These are the smaller businesses in the United States. The smaller businesses tend to be a little bit riskier, and they also tend to earn a higher rate of return because of that. Your large cap funds historically have earned around 10% annual rate of return over time. Your small cap funds have earned closer to 12%. However, there is more risk involved. And then people always ask me, Doc White, what about these precious metals? Should I invest in gold and platinum and silver and so on? To be honest, I'm not a big fan. But most of the professional financial planners are going to say, keep your investments in the precious metals less than 3%, possibly 5% of your total retirement portfolio. The reason is these things are too volatile. Yes, they can do extremely well when a global crisis comes up, but then they tend to fall off pretty significantly. Last time I looked at the gold annual returns over a 30, 40-year period, it was less than 3%. So it wasn't even keeping up with inflation. But in bad times, when global economic crisis, these can do very well for you. But let's not get too much of our money in the precious metal funds. Again, probably keep it less than 3%, possibly 5%. Okay, here's some quick retirement planning tips as we wind her down. A, start investing now as soon as you can. Put some money into your retirement. The earlier you start, the less money you have to invest over time, the less risk you have to take, the more options you'll have when it comes to retirement. Next thing, I would very strongly recommend that you look into opening up a business-sponsored retirement plan, such as a SIMPLE or a SEP. Again, talk with a financial professional to see which one is best for you and your business goals. Simples tend to be good when you have lots of employees who are not family. SEPs tend to be better when you have maybe fewer employees, but they tend to be family, just from the way that who you're looking after there. Next thing, I would strongly recommend that you open up at least one IRA. You can open up both a Roth and a traditional. And again, you can make contributions to both during the same tax year. But right now, if you're under age 50, the maximum combined contribution will be $6,000 between the two. So you could do $3,000 in the Roth, $3,000 in the traditional, $1,000 in the Roth, $5,000 in the traditional. So a $6,000 maximum. Next thing, understand how your business plan works and how your IRAs work. You would be amazed. At Virginia Tech, I would estimate that 80% of the faculty and staff members have no clue how their retirement plan works. They know they have one, but they don't know how the money is invested. They don't know how the money comes out of the account. So know how the plan works. Ask your financial professional for dollar figures. Okay, if I do this, what will I have when I retire? How do I take my money out? What are the tax implications going to be? The next tip is to choose your investments wisely. So again, we need to take into account your current situation. We need to look at your risk tolerance, how comfortable you are with financial risk. We need to look at how much money you want to earn. If you haven't started investing for retirement and retirement's 10 years down the road, you might have to take a little bit more risk than somebody who is somebody who's maybe 30 years from retirement, just because we have to make up for that lost time. Another thing with your investments, diversify. Do not put all of your investments in one company, okay? If you are doing all your investments at the end of the year and investing in business assets under Section 179, you're putting 100% of your money into that business. Folks, that's risky. So think about at least setting some of your money aside into these retirement plans, and then diversify your investments around the world. And again, get that help as you need it, okay? It is worth paying a financial professional to make sure that you're on the right track. Work with your accountant and your tax advisor to make sure you have the proper business plan retirement plan for your business. And then moms and dads, start investing for your retirement now. Moms and dads, get your children to start investing now. If they are earning any money, they can put the money into that Roth IRA or that traditional IRA. If they are working for the business, they can participate in the SIMPLE or the SEP, whatever you choose to use. But let's start getting the entire family started. The earlier, the better. All right, just want to take a couple minutes here and talk about estate planning. I think Jesse Richardson's talked a little bit about this to you, but a lot of people think, well, retirement planning, estate planning, it's all the same. Not really. Estate planning situations we need to think about are controlling your assets while you're alive. We can do this through how they're titled, or we can do it through a gifting strategy. We can look at controlling your assets at the time of your death. This is primarily through a will, but we can also use trusts and some other legal instruments out there. And then we can control our assets after our death through contracts and trusts and so on. So we need to not just think about what's going to happen to our assets at death. We need to think how we can control our assets while we're alive and potentially after our death. A lot of people don't want to think about this. They ignore it. They think, I don't need to worry about it. Well, folks, I'm just going to throw a nasty fact out to you. One of my former students, I believe she was about 30, 35 years old. She woke up dead 3 weeks ago. Just did not wake up in the morning. She left behind a husband and a child, and they had not planned for their estate plan yet. So you're not guaranteed tomorrow. Let's start taking advantage of this. Let's start planning for it now. And the earlier you start planning for your estate distribution and protection, the more power, the more tools you have available. This is extremely important if you want to protect your family, if you want to protect your family's net worth, and you want to transfer and protect the business. Estate planning is critical. Boy, Jesse's probably out there smiling listening to this, but we need to take this seriously. Next slide is going to show you some situations. What happens if mom or dad were to die and they don't have a will and they don't have life insurance? Well, this kind of leaves the rest of the family hanging. So we need to be thinking about how we can protect the ones we love, protect your family's net worth and the business. What if the grandchild wants to come back into the business and then granddad, who owns all the business assets, dies? What's going to happen? In a lot of cases, that means the grandchild is not going to be able to come into the business. What happens when there's a divorce? What happens when there's a remarriage? What happens when there's a birth? We need to think about how your estate plan needs to change. And what about this? What if your business partner dies? How are we going to impact this? Guess what? Life insurance on your business partner is a very powerful tool. So if we start planning for these now, we can help protect their family from major catastrophes. And I can guarantee you that all I've talked about here today, the death part is going to happen. Okay. So retirement, hopefully we'll get there. The death part, yeah, she's coming down the road. So real quick on estate planning. The first step, you need to identify your goals. What do you want people to know? What do you want people to have? When do you want your children to inherit money? Do you want your 15-year-old child to inherit $1 million if you were to die today? I'm hoping the answer to that is no. So maybe you want to think about trusts and so on. But think about your goals. And again, think about your personal and family goals. Think about your business and transition goals there. I'm going to encourage you, just start thinking about it and start talking about it. The earlier you talk about it, the easier it is. As an personal example from this one, a bunch of years ago, mom and dad were still alive. My brothers, my sister and her husband were all at the lunch table or at the dinner table. And it was the day after Christmas. And we were sitting there having a meal. And there was a little bit of a lull in the conversation. So I said, you know what? Let's start the process here. So I asked, or just sort of spoke up and said, so is everybody's wills and power of attorney up to date? And all of a sudden, everybody in the room sort of looked down at their plate and decided it was time to move their peas and their mashed potatoes from one side of the plate to the other. There was a very uncomfortable silence there for, I guess it was probably 30 seconds. It seemed like an hour and a half. Then Dad looked outside and said, oh, it looks like it's going to snow this afternoon. And then the conversation went that way. Well, I said, you know what? I tried. Well, my mom and I were doing the dishes afterwards, and she said, Al, I got to go see the lawyer next week about something related to the farm. What questions should I be asking the lawyer about the estate planning? So we put the dishes down. I said, come on, Mom, let's go talk. We went in the library and we sat there and talked for about 30 minutes. Mom was very detailed. She took 2 pages of notes of what she wanted to ask or what she wanted to think about. While we're doing this, Dad walked by and he said, what are you guys talking about? Hey, Dad, we're talking about estate planning. And Dad, big gruff guy, looked at me and said, well, you know, I've been meaning to ask you. Come on in, Dad. 3 hours later, we left the library. We talked about wills and powers of attorney and advanced medical directives and do not resuscitate plans and so on. Folks, it's hard to get the conversation started, but once you start, it's so much easier. It gets easier over time. It got to the point where after Dad died, Mom and I would sit around and talk about our own personal funeral wishes. You're thinking that's kind of weird. Well, guess what? When Mom died about 5 years ago, I knew what she wanted for her funeral plans. That took the pressure off me and my brother and my sister. So by talking about it, you're actually helping the next generation cope with it. Don't keep this a secret. So there's a long-winded answer to identify your goals. Next, work with an estate planning professional. Work with an attorney who is well-versed in estate planning. And then we're going to deal with the hard versus the soft issues. Folks, the hard issues are always the things like income taxes and estate taxes and minimizing that and transferring the most to the next generation. That's what people consider the hard part of estate planning. That's really the easy part. It's the soft issues. It's talking about your goals. It's the interfamily communication. It's trying to figure out what people want to have happen. Those are the hard parts. Those are the things that really blow up estate planning. So the hard issues that most people think about as far as taxes and estate taxes and income taxes, that's easy. If you walk into an estate planner and an accountant and you know what your goals are, they can very quickly come up with a good solid plan for you. But if you haven't talked about your goals and there's no family communication, you're going to sit there in the lawyer's office and argue back and forth at $300 an hour. Folks, the soft issues are important. You're not going to get to the hard issues if you can't get past those soft issues. So the next thing about the estate planning, the tips, I believe that everyone over the age of 18 should have a durable power of attorney. This gives someone the legal right to take actions on your behalf. And you can specify what those actions are and when they have the power. So I think this is an extremely powerful tool. People say, well, I'm married, my spouse has that power already. I'm going to say put it in writing anyway, just to make sure that it is in writing and it stands up in court a heck of a lot stronger. Next thing, I think that everyone should have an advanced medical directive. This is the big brother to a living will. A living will simply says when death is imminent and inevitable, what level of care you want. And your options are keep me comfortable and let me phase out, all the way to take every action possible to keep me alive as long as possible. It's your choice. By doing this, you get to tell everybody else what your end of life needs or desires are. Well, an advanced medical directive allows you to do that, but it also helps you specify who is your medical power of attorney. It allows you to make direction or make decisions when death is not imminent and inevitable. So whenever you need medical care, the advanced medical directive is much more powerful. And then Jesse probably talked to you about wills and trusts. Life insurance is an extremely powerful planning tool, especially for looking at business transition. The titling of your property, the gifting strategy, how you can gift shares of your LLC to the next generation to bring them into the business. And then a letter of instruction very simply says, okay, when I die, this is kind of, have a big party, invite these people. Here's who I want to be my pallbearers. You know what? It's kind of fun to think about that ahead of time so that your survivors aren't saddled with those decisions. So when it comes to estate planning, clearly define your goals, get good assistance, qualified assistance. I think everyone should have that POA, the power of attorney, advanced medical directive. If you're over 18, let's go and get them now. Next thing, put your thoughts in writing. This helps prevent memory loss or selective memory. And if you put it in writing, let someone else know that it exists. So my mom went through and on my advice and the financial planner's advice, she sort of started to write down what she wanted for her funeral. Well, she didn't tell us where she put some of this stuff. So we didn't know who she wanted for her pallbearers or what kind of music she wanted played at the ceremony. We found it 2 weeks after the funeral. So if you put your thoughts down, make sure somebody knows that they exist and they have access to them. Next thing, don't just set up your plans just to look at or just to minimize your taxes. You need to look at the entire picture. Okay. We need to look at protecting your assets, transferring them to the next generation in a way that's going to help them be successful, making sure you have cash available and so on. So do not do this just to minimize taxes. You need to look whole hog here. The next topic there says we need to look at untitled versus titled property. So if we can move to the next slide, please. With untitled property, that's the stuff that you just have lying around that doesn't have a deed to it. Your titled property, your car, your house, your business equipment, and so on. This, a lot of times, can start the family fights. Okay, who gets mom's China collection, or who gets dad's tool set, or who gets the picture of Uncle Fred. Folks, I want to have a nice conversation about that with all your survivors. With my brother and sister, I'm the youngest of the bunch, but since I deal with financial planning, I sat them down and said, okay, guys, here's the deal. I don't want to lose my relationship with you because we're fighting over who got mom's dishes or who got dad's tools. I want to be, a loving brother regardless. So if I don't get anything, that's fine. And they looked at me and said, well, we feel the same way. And we had no problems at all divvying up the remaining personal items. Next thing, don't think that your estate plan starts when you die. It can be extremely powerful while you're alive in protecting your assets and transferring your assets. So through gifting strategies and titling strategies, make sure you're getting good qualified advice. Another big tip for you here is when you treat kids equally, that's a kiss of death. I love all my kids equally, so they each get a third of a third share of the business assets. You just killed the business. So we need to treat the kids equitably and fairly, but that doesn't mean equally. We need to look at their particular needs. Maybe one needs cash. Maybe one wants the business assets. Maybe one wants the non-business assets. Well, let's try and structure our plan so that your survivors are left in a better situation and they can continue to move towards their goals. All right, let's move let's skip the next slide and go to takeaways. So we can go, there we go. So just to finish up here, what I'd like to walk away here today is one, clearly think about your retirement. What are your goals? What do you want to do in retirement? When do you want to retire? What type of lifestyle are you going to want? Once you know that, now we can start doing some of the math stuff, all the finance things. but clearly sit down and think about your goals for retirement. Next thing, start planning for retirement now. Okay. The more you procrastinate, the more you're costing yourself. I showed my college students an example where if they wait 1 year, simply 1 year to start investing for retirement, they cost themselves $100,000 over the next 40 years. So simply by procrastinating 1 year can take a big bite out of your retirement needs. Start early, start now. Next thing, estate planning is not just important at death. It's critical throughout your entire life, and it's critical for family businesses. So make sure that your retirement plan, your estate plan, your business plans are all meshing with each other. And then again, start the conversation. We need to talk about family finances, estate planning, retirement planning, and so on with all of your family members or your immediate family members. And I'd say let's get the business partners in there as well when we're talking about retirement and estate planning, because if we don't do a good job of that, that's going to have a big impact on the business itself. Well, folks, I believe I have run out of breath and run out of words. So there's an awful lot of information for you about retirement planning and about a little bit about estate planning, just to sort of reiterate what Jesse's told you. But this is something that's near and dear to my heart. I think that the better job retirement planning you do, the better tax management you'll have, the better retirement life you'll have, the easier your business transition will be. So with that in mind, I am going to shut down. I'd again like to thank the Water Systems Council for letting me talk about this one. So if there are any questions, I see first question here, what are the advantages of creating a trust? That's a Jesse Richardson question. But what a trust can do is give you privacy issues so that no one else knows what you're doing or who's owning which assets. It may give you some tax advantages as well. But that's about as far as I'm going to go on what are the advantages of a trust. You really need to talk with an estate planning professional about that. Another question here says, who should you give the power of attorney to, a relative or a friend? And the answer is, it depends. Okay. In my opinion, give that power of attorney or that medical power of attorney to someone that you trust implicitly, someone that you talk to regularly so that they know what your goals are, what your desires are. And for some situations, you might want to choose somebody who is local. That might need to have access to your bank account or sign some documents or so on. It might be nice to have someone who lives relatively close to you. From that standpoint, for my personal power of attorney and advanced medical directive, I chose my brother, with whom I have a very good relationship, but he lives up in Maryland, so he's 6 hours away. So I listed a co-attorney, in fact, and that's someone I've worked with for the last 30 years. He lives directly across the road from me, so he can have much clearer access to my accounts. He can sign the paperwork much easier, and we talk at least once a week, and we've talked estate planning for 25 years, so he knows my needs as well and my desires as well. So in this case, I chose both a relative and a friend to make the decisions. For my medical power of attorney, I chose my friend. And the reason I did that is he makes the pull the plug decision at the end of my life. Well, if my sister were to have that power, just the emotional strain would tear her up. I wouldn't want to put her in that situation to make that decision. My brother, he's an engineer, so he'd say, I'll pull the plug. Well, it's much better that way. But no, just kidding there. But if he says, let's pull the plug, my sister might hate my brother for that decision, and that can tear the family up. If my friend, who is not a family member, makes the decision, now then my brother and sister can hate him for the rest of his life, but their relationship and the family relationship will remain intact. So this is something you need to give very clear consideration to. In my case, for power of attorney, I gave it to both people. So with that, are there any other questions I can answer here today? All right, I'm not seeing any other questions coming in. Folks, I want to wish you the very best. I want to wish that you go out and start talking about retirement planning, start investing today. The earlier you start, the easier your life will be. And with that, again, thanks to the Water Systems Council for inviting me to talk to you. If you have any questions, feel free to email me or contact the Water Systems Council, and they can get a hold of me. And on that note, I'm going to go jump in the lake that's right behind me here, or jump in the waterfalls, just to relax and get away from Zoom for a while. Folks, I wish you the best. Take care.